Hello friends, welcome to the Good, Bad and Ugly weekly review for the week ending 10th of January. This year 2025 has not started on a good note. We've lost some ground in just 10 days. FIIs continue to sell. Retailers are buying, but I think at some point of time that retail buying also could get a bit, less buoyant, if I may use that word. Uh, so we are very keenly now looking at the three major events coming up in the next 20 days. One, of course, is a big budget, which is likely to unleash some uh, disposable income in the hands of taxpayers by reducing tax. That is the expectation now. Um, President Trump comes into office January 20th, and he may do some tariff talk that can impact us. And the one biggest factor that is going on right now is the US dollar INR, uh, narrative that almost everybody is willing now to consider that rupee should be at 90. We are just at 86, and it's almost like a consensus that rupee should be above 90, and that is one thing that will cause a lot of foreign investors who were even wanting to come in case they were wanting to come in, to wait. A lot of uh, you know NRIs who are sending money or buying any assets here, they will also wait. So by creating this narrative, I think the market has shot itself in its own foot. And now, until the rupee really declines there, a lot of these investments will stop. That is just my view, could be right or wrong, but that expectation is now driving the markets down, actually. uh, we are doing a special episode series from this Sunday onwards. It's called Momentum Misfits. We'll talk about what is momentum score, how some stocks which have low momentum scores should not be in your portfolios, and so on and so forth. So this is what we are going to start from 12th of January. From the research desk this week, we had some fantastic content pieces. One questioning whether this was really a bull rally that we had in the last few years. Small caps in the US versus India. Where is the money headed towards? The big bond crisis is brewing. Is our retailers gambling hard in the market? The survivorship struggle. Uh, you may be making a lot of mistakes. Some content on that. Will there be any interest rate cuts in 2025? Emerging markets, can they outperform the American markets? And the looming concentration risk in the US markets. These and many more content about all kinds of market facets of the market are available, not only on the Weekend Investing blog, but on the Weekend Investing newsletter, on the Weekend Investing app. So it's your choice where you want to consume that. This is the disclaimer. Please read the disclaimer fully. It is for your benefit. And let's jump in. But before that, please do subscribe to the channel. We would love to have your subscription to the channel. Intra week overview for the Nifty. You can see the entire week we were just falling. From the 3rd of January, we just fell from 24,200 to nearly 23,350. The first couple of days of the year were very encouraging, but then everything beyond that has petered out. And right now we are at the cusp of breaking down from this previous bottom. The 200 DMA is successfully broken down. The 50 DMA is also coming close to making the death cross. We did a video on this earlier. You can watch that. And the market is yet to get into the oversold zone. So even the, uh, you know, despite reaching the previous lows, we are not yet in the oversold zone here. So we may go a bit lower. My sense is that you should prepare your mind that the market may go to the bottom of this election day candle at 21,300. That preparation of mind should be there, because when and if it does come, it should not shock you uh, totally. It may not completely happen. That is also okay. So I'm not saying that it will happen, but you should prepare your mind that that may be an eventuality you may have to see. minus 2.39% for this week. The weekly chart is looking like the continuation of this down move that happened 4 weeks back. And we have a relief rally, and now we are moving down. So the structure of the down move is very much intact. So we had a big down move. We had a reaction to that. We moved down again. We had a reaction to that. We moved down. This initial low has not yet been broken. This initial low of the first leg is not yet broken. That is the only silver lining so far. Once it does get broken, a lot of rule based, algorithm oriented sales will come through. A lot of folks watch levels, a lot of folks watch pivotal levels, and that may cause a lot of selling if this low breaks through. That has not happened so far, and let's hope it doesn't happen. Even if it does not happen, you will need a lot of consolidation in this area and eventually taking out the most recent pivot before which you can say that maybe the downside is over. That is not yet there. The S&P 500, the mother market in the US, also looking down, although not as bad as India. You can see the trend is still higher highs, higher lows on this since last November. And while it has come off a bit from the recent highs, I think the market is also waiting for the president to come in and speak. Gold is up 2.36% for this week. This is the INR gold. A lot of folks say, how do we calculate this? So just to take a moment, if you go to trading view, select XAU USD, which is the spot gold price, multiply it with USD INR to get the equivalent price in Indian rupees, multiply it with 1.06 because 6% or so is the duty, and divided by 31.109, which is the conversion from the troy ounce to grams. So the spot price XAU USD is $2,700 per troy ounce. So we want to convert it into grams, and that's how you come to 7894 rupees per gram as the closing price. And if you would have noticed, we have closed at an all-time high weekly close. This is somewhat similar to a situation that we were here in July, and this kind of a move happened post that. That is a possibility that is likely to happen in my view. Dollar index is getting very, very strong. We are now at 109.64. The more this remains in strength, the weaker the other currencies will become, and more is the money that will flow to the US markets, and more will be the selling in emerging markets. So this is the, you can say, the crux of the matter why FIIs are selling, because the dollar index is telling you that it is pulling in money from all over the world to the US markets, to US bonds, to US equity, and every other currency is falling versus the dollar. So why would you want to be in a falling currency? This, whenever and if it turns down, that will be the point where emerging markets will start getting flows from foreigners. In the benchmark indices overview, you can see we lost 7% on Nifty Next 50 this week, 6.5% on Nifty Small Cap, 5.4% on mid caps, 4% on Nifty 500, and 2.39% on Nifty 50. Quite a dramatic week down this one. If we see the last 1 month, we've lost 12% on Nifty Next 50 and 8% on Nifty small caps, 5% on Nifty. Over 3 months, again, similar picture. 6 months, similar there. And over 1 year is where, the gains. So if we were to step back from this very recent weakness in the market and see the market from a slightly global perspective, more wider perspective, then in the last year things have not really gone bad. I mean, in the last 1 year, you still got 9% on Nifty, you still got 19% on Nifty Next 50, 17% on small caps. So the heavens have not yet fallen in terms of market returns. Last 1 year has still been good. Last 3 years is CAGR basis still very good. Last 5 years, of course, is phenomenal, 14% and 27% here. So I think while the short-term moves may have disappointed a lot of folks, and maybe anxiety and fear is also there in some, but see it from the perspective that you are here for a longer term, and even 1 year the stats are still looking good. So don't worry too much about the market. The markets will take care of themselves over time. In terms of the sectors, you can see this week PSU banks lost 8%, real estate 7.8%, public sector enterprise 6.9%, media, energy, central PSEs, metals, commodities, all losing more than 5%. So no place to hide this week totally. FMCG, which was the weakest link in the last many months, has reduced its down move, and IT has been the only one which had a up move this week. Over the last 1 month, you can see everything has been in the red, with the media, PSU, banks, metals doing the worst above 12%. But here also, if we take a 1 year view, you can see that media is basically Z is one of the major components of this media index, so we can ignore that actually. Private banks and energy and FMCG, these three have really not done anything in the last 1 year. So your strategies should have avoided these stocks in the last 1 year. If they haven't, then have a relook at the strategy. Now, in terms of the best performers in the last 1 year, you have pharma, IT, auto, and central public sector enterprises. These should have been some part of your portfolio in the last 1 year, given that we have this data now for the last 1 year. Over the last 3 years, of course, most of the sectors have been in the green, but on a CAGR basis, many sectors have performed much under the market. And again, there have been only few sectors which really popped out in terms of their returns. And of course, over 5 years, everything is green, but oil and gas is still not there. Real estate, CPSE, metals, and autos have done phenomenally well in the last 5 years on a CAGR basis. If we see from a momentum score perspective for short term as well as medium term outlook, then IT, pharma, consumption, and services sector, these are the leading current sectors from a momentum score perspective. And IT, you can see across all different frequencies, has been amongst the top three. Pharma very recently has started to slip. Consumption stories have remained reasonably robust. And in services also, you can see the ranking has been maintained. FMCG of late is relatively doing very well versus others, and hence in a weekly basis, the ranks have improved in 1 week and 1 month. Earlier, over a year, they had really dropped very hard. Metals, public sector enterprise, PSU banks have all dropped much lower. So the idea here is that the ranking is suggesting that they will take time to come back up. Trend check, you have 24% CNX 500 stocks above 50 DMA. So 76% are underwater 50 DMA, and 62% are underwater 200 DMA. And that is quite a bleak picture that we have right now. In the indices, you can see for the 200 DMA, we have 43% stocks in small caps. So small caps are still doing much better than other categories, where mid caps has 36% stocks only above 200 DMA. Nifty has 34%, and Nifty next 50 is the worst hit. Only 22% stocks. So only 11 stocks out of the 50 are actually above 200 DMA. Everything is down under. That is the sort of very perilous position of Nifty next 50. And if 200 is this position, then 20-day moving average will hardly have anything. Again, 22%, 23%. So you have very little number of shares which are holding up and above the shorter term moving averages. In the sector space, again, 200 DMA, if we check, 80% of IT stocks are above 200 DMA, 75% in pharma, 46% services, and 40% private banks. This is probably the place where you should be able to find setups if you are a discretionary swing trader or investor. The other ones which are below, most of the stocks are below moving averages of 200, and that's where most of the stocks would be languishing down. In the shorter term moving averages, you can again see IT and pharma are the only place really where the concentrated number of stocks are still doing well above the 220 DMA, and PSU banks, nothing is above the 20 DMA. I think maybe PSU banks is nothing above 50 DMA, nothing above 100 DMA. Oh, nothing above 200 DMA. So all PSU banks are basically in a deep red situation. FII DII stats is only red to see here. The entire week sell, 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 sell. So nothing to report, and then the selling is pretty deep every day. Almost $500 million is getting sold. Let me also do the DII check. Okay. DIIs are giving a very good counter so far. In fact, very good purchase amounts of 5,000 crores, 7,000 crores this week. I hope they can continue this uh, activity. The cumulative activity in the last 1 month, DIIs have put in 57,000 crores, FIIs have lost or taken out 47,000 crores. So net, there is still institutional money coming in to the market, but the market moves more by the sentiment of the FII outflow. So that is also one reason where, despite no net inflow or outflow, markets are still coming down. So that's all I had for this week. I hope you like this content. Do let us know in the comments which parts of this video you really liked or you did not. It will help my team to even create a better content uh, accumulation for the next videos. And this is essentially a weekly activity that we do. Do follow us if you like these videos. Give us a subscribe. The team gets motivated. And I'll see you in the next one. Thanks. Bye.